So we're going to revise the topic investment appraisal. Investment appraisal. And this is otherwise referred to as capital budgeting or capital investment decision. Capital budgeting or capital investment decision. So the issue of capital budgeting is a basic business decision which every business will be involved in. The fact that you have a business and you have the plan to grow, you will definitely make capital investment decision, because as a business person, you are not expected to be stagnant. Your mindset should be a growth mindset, that where you are today, you should surpass that tomorrow. So for you to attain that height that you desire, you must be involved in capital investment decision, which is otherwise known as investment appraisal. So when we talk about capital investment, which is otherwise known as capital expenditure or capital budgeting, this is a process that an organization is involved in committing its funds, money, into long-term projects. And these long-term projects span beyond one accounting period. And example of capital investment projects or decisions can be construction of bridges, roads, refineries, plants, lands, building, and so on and so forth. So in appraising your investments, there are various criteria that you can look at for. You can use the payback period. You can use your net present value. You can use your internal rate of return. You can use your accounting rate of return. So these I've mentioned, they are categorized into two forms. We have the discounted cash flow method and we have the non-discounted cash flow method. Under the discounted cash flow method, we have the net present value, we have the internal rate of return, we have the modified internal rate of return, and we have the discounted payback period. Now, under the non-discounted cash flow method, we have things like the payback period. We have the accounting rate of return, and also we can look at the issue of majorly payback period and accounting rate of return under the non-discounted cash flow method. I believe most of us have an idea of all these. Yes, we're just trying to revise, to do a revision on some of these things. Yes. So now I will just display some examples as it relates to cash flow, as it relates to payback period. Then we'll just do a brainstorm before we move to the main business of today. Yes, we'll do a brainstorm before we move to the business of today. So I will just put forth one or two examples to test our understanding on some of these concepts. So we can have this. I will use this example to explain payback period in two different ways. So let's take this example. you have you have 100 million to invest in different forms of projects. You have 100 million to invest in different form of projects. But how will that be? Let's say we have project A, you have project B, you have project C, you have D, you have project E, and your initial investment that you have, initial investment, initial investment, we have it, we have 100 million to invest, you have 100 million to invest, you have 100 million to invest, you have 100 million to invest, 100 million to invest, but you are faced with which of these projects you are to invest in, which of these projects you are to invest in. Now, the projection is this, the cash flow projection for year one, year two, year three, let's have it year four. Now, in year one for project A, I expected to have, let's say, 25 million in return. In year two, 25, likewise, year three, 25, year four, 25. You can see this is a constant cash flow over time. For project B, your cash inflow is expected to be 20 in year one, 20 million in year two, 20 in year three, and 20 in year four. For project C, initially in year one, expected to have cash flow of 10 million and 40 in year two, and in year three, you can have 50, in year four, you can have 100. For project D, the cash inflow in year one can be 50, this can be 40, and this can be 10, and this can be 100. And in year for project E, initial cash flow, have it as 35, these as 35, and in year three, you can have it as 120, in year four, you can have it as 400. 400. Now, what I've put down here, using payback period, what are you going to do? Using payback period. The question is, for project A, the payback period will be when? The payback period will be which year? The payback period will be which year? This is an examination situation. You talk to me now. You have 100 million to invest. Now, the basis of your investment will now be how quick will you recoup your money? How quick will I get back my money? If I'm to look at project A, if I invest 100 million and year one, I'll get 25 million, year two, I'll get 25 million, year three, I'll get 25 million. Well, let me still include one more year here because I'm seeing something already. Seeing something here. So this should be 100, this should be 100, and this should be. Now, in here for project A, when will I recoup back my money, my 100 million that I'm investing? If I'm to keep getting 25 million every year, the payback period will be when?
Year four, sir.
The payback period will be year four. Will be year four. Why is it year four? 25 in year one plus 25 in year two plus 25 in year three plus 25 in year four. When you add everything to give you what? To give you 100 million. give you 100. So it means the year or the period that I will recoup back this 100 million will be year 4. Now, take note, this is a constant cash flow, right? Since this is a constant cash flow, you can work it in another way. That if I'm to invest 100 million, since I have a constant cash flow, which is 25, 100 divided by 25, we give you what? We give you what? 4. We give you 4. So when you have constant cash flow, you can determine your payback period by saying your initial investment divided by what? Your cash flow. Initial investment divided by your cash flow. That is, your initial investment is what? 100 million. Your cash flow is 25 million, being constant. So you just say 100 divided by 25, it will be, the payback period will be 4 years. It will be 4 years. This is one scenario, 4 years. Now, for project B, when are you going to recoup back your 100 million? Looking at project B, if you are to keep getting a cash flow of
Year 5, sir.
year what?
Year 5.
5.
Year 5, year
5,
5,
5, yeah, 5.
year 5, year 5. Now, based on what I've just explained, since we have constant inflow, you can just say 100 divided by what? By 20, and you get still 5. You still get 5. You still get 5 years. 5 years. Still get 5 years. Now, for project C,
Oh dear.
when will you recoup back your money?
Oh
Year
dear.
3.
Year 3.
Year 3. Okay, this is so direct. I don't want it to be direct. Okay, fine. Let's keep going. There's another point I will show what I want to show. So year 3, that is 10 plus 40 plus 50, you recoup back 100. And project D, likewise, it will also be year 3. It will also be year 3. But here, for project E, what will happen here? For project E, what will happen? For project E, which year are we going to recoup back our money?
Second year.
Which?
25.
Year 2.
Yeah, 2.
Year 2. Look at it very well. It will
2
be year
years, 3 months.
Yes,
2 years, 3
years.
months.
3
year
months.
2.6.
This is where I want to. I actually am concerned about. So where you can't determine the payback period perfectly, what will you do? Now, if you add 35 plus 35, you have what?
70.
70. When you add 120 to it, you see you overshoot
Yes.
100 million to a very large extent. So what will you do? It means within 2 years, plus what?
That's
Plus how much do you need to recoup to make it 100 when you add 35 plus 35?
you mean
30.
It's 30.
30.
You need 30.
So that is that
So it will be the shortfall. Just look at the formula. It will be
2.25
the shortfall, which is 30,
divided by
the next cash flow. The next cash flow.
120.
And the next cash flow is what?
120.
120. 120. Should, in case you used to confuse yourself here before, don't confuse yourself again.
Yeah.
So this is it.
30 over 120,000.
So when you now simplify, it will be what? 2 years
0.25 times 12 was
0.25
divided by 120. The result will be what?
0.25.
2 years. Okay, 2 points.
0.25 times 12 it will be 3.
Okay, yes, you can 0.25 times 12. So let me just show you this way. 2 years plus 0.25 multiplied by 12. So to give you the years. So it will be 2 years what?
2 years, 3 months.
2 years, 3 months. We are multiplying by 12 because we want to get it in months. We want to get it in months.
Okay.
That is why we are multiplying that decimal by 12 to get it perfectly in months. But you can still leave your answer in that way. That is 2.25. Yes, we want. It's still okay. But if you want to now get it in months perfectly, that decimal portion, multiply it by 12 to give you the perfect month. So this is what I want to show with regard to payback period, to refresh our understanding on payback period. Now, talking about the accounting rate of return. The accounting rate of return. What is accounting rate of return? This is revision. You should be teaching me by now. Accounting rate of return. Yes.
Average profit of average investment times 100/1.
Okay, that is very good. Average profit divided by average investments multiplied by. Now, the question is this. How do you get your average investment? How do you get your average investment?
The initial outlay.
Cost
Initial
minus
investment over
Plus
cost
CAP.
plus
Plus
Divided by
Accounting rate of return. Accounting rate of return. Take note, this is a non-discounted method likewise. So it makes use of accounting profits.
yes.
Make use of accounting profits. Sometimes you can be giving financial statements. When you are giving the financial statements, don't allow that to throw you off balance. All you need to do, go to the financial information given. Determine the profits. Get the profits in the financial statement and fix in the formula as appropriate. So this accounting rate of return can otherwise be referred to as what?
Return of investment. Return on investment.
Return on investment or return on capital employed. Yes. So just as we've said, the accounting rate of return is the estimated average annual profit divided by estimated average investment multiplied by 100/1. So the question I'm asking is, how do we get our average investment? The average investment is your initial outlay plus residual value divided by what? Divide by 2. Divide by 2. Divide by 2.
Plus working capital.
If it's given,
Yes.
So now, in a question where you are giving your initial outlay, you are giving your initial outlay, and you are giving depreciation, and you are giving your expected residual value. For you to get your annual depreciation, what will happen? How do you get depreciation? Your depreciation will be what?
I think profit before
Outlay minus
initial
fiscal
outlay
value.
Scrap value divided by the useful life of the
By the
project.
useful life.
Yes.
Okay. Since this is a classwork, everybody is on fire this morning. So you quickly solve these now. So this is a question. I think we've solved this before, but let me see what will happen now. A company has a targeted rate of return of 22%, and is now considering the purchase of an asset, with the following information. Now we have capital outlay. We have it as 85. We have estimated profits. Estimated profits before depreciation. Estimated profit before depreciation. We have year one. We have 18,000. We have year two. We have it as 25,000. And we have year three. We have it as what? 38,000. And we have year four. We have it as 45,000. Expected residual value. Expected residual value is 2,000. The question is, calculate the accounting rate of return. Calculate the accounting rate of return on the acceptability of the project. So what is the answer? Calculate the accounting rate of return on the acceptability of the project. So what is my answer?
20,750. 20,750.
2750 is what?
Is the answer? Is the annual depreciation?
The annual depreciation.
Annual depreciation.
Yes, if that is the annual depreciation, what is my accounting rate of return?
Estimated average.
You've done step one. So the question you should ask yourself is, what is accounting profit? isn't it?
Accounting profit is the profit after depreciation. You
Very
must
good.
have less depreciation before you get
Very good.
accounting profit.
Very good. So now, since you've determined your depreciation, and in the question you are giving estimated profit before depreciation. So what are you now going to do? I will
You
not tell
less
you.
your
Just remove
depreciation.
the depreciation.
Less precision.
Very good. Yes. So for each of the year, remove the depreciation. It's a straight line depreciation, 2750 annual depreciation. Remove it. 18 minus 2750, what will you have? 25,000 minus 2750, what will you have? This will be profit after depreciation now.
Please, away it's 2750.
Ma, get your depreciation. Get your depreciation. You just join. We've mentioned that before.
Okay, sir.
Solve your depreciation.
Sir, can we add all the profit and you just add depreciation from it?
If you want to do that, you multiply that depreciation by how many years? By 4.
Oh,
Because 2750 is just for 1 year. And when you do
750.
so what is my this is revision class?
43,000.
Yes, your profit after depreciation will be 43,000, isn't it? Your profit after depreciation will be 43,000. I know we are not on the same page, everybody, so that is why I have to show some of these things. So your annual depreciation is
We are coming.
initial outlay minus residual value
Over 4.
divided by useful life. Useful life of the projects. Useful life of the project. Useful life of the project. The question, the annual depreciation will be equal to what? Your initial outlay is given in the question as 85. Your residual value given as 2,000. Divided by how many years?
I think the profit is 10,750.
Yes, that is the annual average
Yes.
profit. 750.
Yes.
10,750.
Yes. Yes, so move on, right?
25%. Yeah, is 25%, I thought.
Yes, you are very
Approximately.
correct. You are very correct. 25%. You are very correct. Please, let me ask.
Sorry, Mr. Topper, it's supposed to be 27, not 10,750.
Yes, it's 2750.
Okay, yeah, 2750, sorry. So now let me ask. I believe
I
I
got
believe
24%.
Yes. So hope everybody we've been able to get our accounting profit. If you know you've not gotten your accounting profit, just raise up your hand. I want to know if I should continue solving or I should forge ahead.
And sir, please, this 85 is from where?
This is it. Your initial outlay.
Thank you.
Sir, please continue.
No, I'm seeing some hands up. Let me know what's the problem. Madam Vivian,
Good morning, sir.
good morning. So I should solve, right? I should continue the solution.
Okay. Yes. Okay. Yeah.
Okay, no problem. Let's quickly solve. So now we have the annual depreciation to be this. Now, for you to determine your accounting rate of return, you need your accounting profit. In the question is telling you that estimated profit before depreciation. It means depreciation is yet to be deducted. So for you to get your accounting profit, this profit here, you less depreciation from it. You get? So we'll now
Yes.
move to the next step. We move to the next step.
Sorry. Stop. Let me just take it. That's where I'm having. Do I subtract the depreciation from each of them, or can I sum it together and subtract the depreciation? That's where I'm even having an issue.
You can do it both ways. You
Okay.
understand? Yes. So you see what I'll do now.
Okay.
You see what I'll do now. So now, let's say calculating profits.
So my
Profit.
account profit is 111.49%.
Okay. We are going to see if you are right or if there is need for improvements.
Okay.
So now we have it. So we have our year. I'm going to show it step by step since this is revision anyway, but I know some persons still need some serious brushing. So profits before depreciation, and our depreciation is what? And your profits after depreciation. So now in year one, the profit before depreciation is what? 18,000. Your depreciation is what? 2750. Profit after depreciation. This is a loss of what? 2750. In year two, your profit before depreciation is 25. Your depreciation is 2750. You have a profit or loss? Profit of 4250. In year three, what is happening there? Profit before depreciation. You know you are not talking, you can mute yourself so that we'll have a clean recording. So in year three, the profit before depreciation is what? 38, and depreciation is what? 2750. Profit after depreciation will be what? In this regard, 17,250. And in year four, it will be what? The profit before depreciation is what? 45. The depreciation will be what? 20,750. Profit after depreciation will be what? 24,250. So overall, total, when you add all this, you should have 126,000. When you add all this, you should have what? 83,000. The difference between both will give you what? 43,000. So this answers the question. Either you do it, you add all this together, multiply your 2750 by 4, you get this. This minus this, you get what? 43,000 as your total profits after depreciation. So what will be your annual average profit? Your annual average profit. Your annual average profit will be what? The annual average profit will be what?
43 divided by 4.
43 divided
43,500.
your annual average profit will be
Divided by the useful life of the project, which is 4, will give us our average profits.
let me see how much this. So calculating average profits, it will be what? Annual average profits. Annual average profits will be equal to total profits. Total profits divided by what? Useful life. Divided by useful life. So from this, your total profit is what? 43,000. Useful life is what? It's 4. When you divide, you're going to have what?
10,750.
10,750. Going to have 10,750. So with this now, with this, you can now move further to calculate your average investment. Average investment. Calculating average investment. Your average investment will be what? The average investment will be what?
Initial
Outlay
value.
plus scrap value divided by 2.
So initial outlay plus what? Residual value divided by what? Divided by 2. So from this question, your initial investment is what? 85,000 plus your scrap value is 2,000. Divide by 2. This will give you what?
500.
43,500. So with this now, can you now calculate your accounting rate of return? With this.
Yes.
So the accounting rate of return, the formula is what? Let's see. So calculating
Average, accounting profit divided by average investment.
okay, calculating accounting rate of return. As you write in the exam hall, you give headings like this. So you don't just write anyhow and say You give appropriate headings to what you are solving. Give appropriate headings. So calculating accounting rate of return, which is ARR. So we now have it as what? The formula is what? Let's write it out. It is depending, you can say estimated average annual profit. Average annual profit divided by what? Estimated
Average investment.
average investments. Multiply by 100. So when you do this, from all what you have above, the result will be what?
25%.
Estimated average annual profit 10,750 divided by what?
43,500.
Divided by 43,500. When you do this, multiply by 100, your answer will be what?
25%.
Approximately. So this is what they want you to do. This is what they want you to do. So the question is, what will be your advice? Because what is it? The question is asking us to do what? Calculate the accounting rate of return on the acceptability of the project. A company has a targeted rate of return of 22%. That is their target. So based on your result of 25%, what will be your advice?
We should invest on it.
Why?
Because
The
it
project
We should reject it. We
There
do.
is one.
is lesser than the calculated ARR.
Okay. So the project's accounting rate of return of 25% is higher than the management target of 22%. Therefore, the project should be accepted. But if we have a lesser value, it should be what? Rejected. It should be rejected. So that is that for accounting rate of return. Just to refresh our memory on that, just to refresh us on that. So we can look at the issue of NPV. I'll just look at four basic techniques. NPV. The issue of NPV, net present value. The issue of net present value. Now, for you to solve questions on net present value, what are the things you need to look out for? For you to solve questions on net present value, definitely you have to look at what is the initial outlay, the outflow. The initial outflow is very important. The initial outflow. The question will not tell you this is the initial outflow. They will tell you that the organization is to invest this as at the beginning of the project. So it's you that will know that, okay, this is the initial outflow. This is the initial outflow. So now, let's just show a very simple one to refresh, so that when we go to the big question, we know what to do. So the problem most students usually have is how to get their discounted cash flow. How to get the discounted cash flow. So let's pick a question. I think you should be able to solve that. Let's look at a question. I'll give two questions. Let's say Anike Limited is considering, hope this is not somebody's name here, is considering a project with the following estimated future cash flows. Estimated future cash flows. Estimated future cash flows. So we have here, we have cash flow. Cash flow. Year zero, we have it as 150,000 outflow. We have year one is an inflow of 60,000. We have year two, we have an inflow of 75,000. We have year three, an inflow of 50,000. We have year four, an inflow of 25,000. The company's cost of capital. The company's cost of capital. Cost of capital is 10%. Required. What is the NPV of the project? What is the NPV of the project? And advice if the project should be undertaken. If the project should be undertaken. So I believe you should give me my answer by now. So what will be the answer to this? What will be the answer to this? That you have this, your cost of capital is 10%, which will be your discount factor. Which will be your discount factor. Discount factor at 10%. So in year zero, your discount factor, please solve. I'm waiting for your answer. I'll be waiting for my. What I'm doing is for those that are just seeing this for the first time. So your present value will be what's. Here's my calculator. For year one, based on 10%, that is 1.1 to the power of minus 1, 0.90. Now, let me ask, for those that, do you know how to get discount factor? If you know you don't know, so raise up your hand, let me see. Okay, Ajia, these are. Okay, all right, fine. So this is it. You can get it in two ways. In your question paper, you see a table. You see a table. Let me go and show you now. I think I have it here. Let me change my slide. In your question paper, you see a table. That is, if you want to go with the table. Can you see my screen? Okay, fine, you can see it. So in your question paper, you see this table, discount rates. Ajia, these are.
Sir?
In your question paper, you see this table. In year one, our
Okay.
discount factor, our cost of capital in the question is what? 10%, right?
Yes, sir.
So see 10. Do you see 10?
Yes, I can see.
So this N here, period, means the year. Now, in year one, when your discount factor is 10%, what will be the value, your discount factor?
0.909.
So if you press your calculator to, you get the same result. So in year two, your cost of capital is 10%. What will be your discount factor? It will be what?
1.736.
So that is how to read it. So if your cost of capital given in the question is 5, and you are looking at year one, what will you do? Just come under year
5%.
1%. You just pick it. It saves you time. Yes.
Oh,
So let's now go to how to compute it using your calculator.
Mr. Tope,
Yes, ma.
is this table be given to us in the exam hall?
Yes, it's there. See it. This is your question paper. This is the question paper. It's there behind every question
Okay.
paper of financial management. So you see
Sir?
all those formulas, all those cost of equity gauge. Do you see it?
Yeah.
So you can see this our cash management model, our spread. You can see it.
Yeah.
Miller
Okay.
all. Yes. So they are
Hello,
all.
Mr. Tope.
Yes.
Sorry. If you look at that year two, that's the annuity. This is not for just that.
Yes.
Is the annuity. This is the discounting factor for annuity, right?
This is
It's for these 2 years for 10%.
for 10% in year one is
It's fine.
0.9,
Yes. For the second year,
1.1 to the power of 2. Yes, that one is for the annuity. That's second year is for the annuity. It's for the annuity. Let me see. So let me see. 1.1 1.1 1. Let me press 1.1 on your calculator to the power of 2 to give us what?
1.21.
1 point what?
The power of my 0.826.
No.
0.826.
0.980.
0.826.
Okay.
0.826.
Sorry, which year?
Year two
Yes.
now.
Yes. So 0.826. Yes. So this value in year two is not corresponding. It's not corresponding to the discount factor. Is the annuity. Is the annuity. Yes, just as she has said.
Yeah, but I'm having 0.826
Yeah, 0.80.
on my calculator.
Yes, 0.826. It's just
What I'm having is different, sir.
so. Don't worry. Let's go by our. Let me show the calculator approach. Yeah, I don't used to work by all what is given in the paper. So now, for you to work by your calculator approach, the formula is what? What is your formula? Though the formula too is also in the question paper. So the formula is what? For you to get your discount,
1 divided by 1.1.
No, 1 plus r raised by minus n for discount factor.
is in two ways. 1 plus r.
Is it too much?
1 plus r. You can do it in two ways. 1 plus r to the power of what? To the
Minus
power of minus n. You can do it in two ways. So when you raise this up, you have it this way. Or
1 plus r raised by n.
or you can do it this way, or 1 divide by what? 1 plus r.
R raised by n.
1 plus r to the power of n. And on the negative way, either 1 plus r to the power of minus n, or 1 divided by 1 plus r to the power of n. Now, based on this, in year 1, what will happen? It will be what?
0.90.
0.909.
So we have it as 1 plus
1 plus
0.1
raised by
to the power of minus 1 to the power of minus 1. So when you do that, you're going to have what?
1.1 to the power of minus 1.
So the outcome will be what?
0.909.
0.909. So for year 2, what will happen? It's just for you to change this to the power of minus 1 to 2.
Minus 2.
When you change it to 2, you have what? 1.1 to the
Zero-
power of 0.
826.
And for year 3, it will be what?
0.051.
0.751.
751. In year 4,
0.683.
0.683.
683.
Yes.
So what will you do next to get your present value?
Multiply
Multiply
with the cash flow.
So now your present value as at year 0 will still be what?
150,000.
150,000.
In year 1,
54,540.
54,
In year 1 is
540.
minus 150,000.
Year 2, 61,950.
54,540.
Year 3,
Year 1 is
7,550.
7,550. Year 4 is 17,051. 075.
61,950.
Just excuse me. Let me get it one after the other. Year 2,
61,950.
950.
950. 950.
Year 3,
950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 950. 37,550.
Yeah, 4.
17,075.
So with this, can we determine our net present value?
21,115 naira.
21.
115.
So the question is this: what is the NPV of the project and advice if the project should be undertaken? What will be the advice?
It should be accepted because
Because
it
we
has
have
a positive
net
present value.
All right. So it should be accepted. Now, beyond that, I want us to look at this in a practical way. Yes, beyond just knowing it, what is the meaning of all this? Present value. That if you are to invest 150,000 naira today, how much will you get back in return? That is the value of this investment in the next 4 years. What will be the return as at today? What will be the return as at today? You are projecting that, okay, in the next 4 years, you will get this value, 21,115. Yes, but as at today, the money value of this investment, looking at it, having a projection of 4 years, will be the present value of your return will be what? 21,115. And since it is a positive outcome, you should accept the project. But where it is a negative, it means it is not worthwhile investing your money in this project. Now, this can also lead you to internal rate of return. Internal rate of return. With this, can we compute our internal rate of return? With this,
Yes, sir.
since we have a positive NPV now, what are we going to do? Because for you to compute internal rate of return, you need a positive NPV and a negative NPV. And what is our formula for internal rate of return?
Lower rate plus NPV lower rate over NPV lower rate minus NPV higher rate multiplied by higher rate minus lower rate.
Okay, that is fine. People are set for these exams. They should just bring the paper. At least you have rest of mind. Every day you wake up, you are thinking of these exams. So the formula for the internal rate of return, let me write it out for those that this is their first time. But if you know the formula, quickly solve. Let's get our internal rate of return. Yes, Madam Chuma.
Okay, sir. My question is that, please, what is advisable in this approximation of decimal points? Is it to how many nearest decimal points? Because of some people could do it 4 decimal points and have almost slightly different answer from the others. So advisable, sir.
Yes, you can just do 3 or 4 decimal place. Once your result definitely might not be the same with the marking scheme, but the markers are enlightened and they know that once your answer is within this range, it is fine. Yes, it is fine.
Okay.
And what they do is they mark your step, and once you are consistent, you can just put a note That's notes. The workings is to 3 decimal places. You understand? So they know that, okay, this is what you are working with. And definitely anything that involves approximation, they will not penalize you for not getting same result like what has been prescribed in the marking scheme. You understand?
Okay, sir.
Because they know there will definitely be variation, yes, in calculation. So, but your answer should be within the range of a particular value. Yes. So that is
It's
how
okay.
it works.
Thank you, sir.
Yes, ma'am. So for our internal rate of return,
Hello, sir. Sorry, I want to ask a question.
yes, ma'am.
Sir, for this NPV, you did not make mention about when the cash flow is constant. How to solve using the annuity.
Okay. So, but do you know how to do it, ma'am?
Yes, sir.
Okay,
Yes.
fine. So where the cash flow is constant, yes, you can use annuity. I believe you know annuity formula. Let's see. I think I have it somewhere here. The annuity formula is what? Is 1 minus open bracket 1 plus r to the power of what? To the power of, okay, here, this is it. You can see it. This is the annuity formula. To the power of minus n divided by r. So where you have a constant cash flow, you might not need to do it year in, year out. Yes, you can just have a cumulative factor and use this formula to get your discount factor. Yes. So now, for our internal rate of return, what will be our results? Our internal rate of return, the formula is what? I will just show a very simple formula, unlike the one I used to show before. Internal rate of return.
That's for brackets.
What do you have, sir? Internal rate of return. So you can have it as IRR is equal to, I will use this simple one, A, capital A plus small a divide by A minus B take note, A divided by A minus B multiply by what? The capital B minus. The question is, what is my capital A? Where A is equal to what? Lower rates. Lower rates. And B, capital B is what? Capital B is higher rates. Is higher rates. And my small a is what?
MPV of lower rate.
That is positive NPV. And my small d is what? Negative NPV. Negative NPV. So this is the formula. So based on this question now, we have a positive NPV already, right? So to get a negative MPV, what are we going to do? Use a try and error approach.
Yeah.
What are we going to do?
You use higher discounting factor.
To use average, either 15 or 20%.
So yeah, use it.
20% is fine.
Answer is
Not 17.5.
17.5.
It's this noise. I don't like this noise. Let me see. If you want to talk, just so if you want to talk, raise up your hand. Just tell us what is happening. So when you use a higher value, yes, roots.
I use 20% and the result is 17.5%.
17.5.
17.5%.
Okay, that means you incorporated everything into the formula.
Yes.
Okay.
So the negative MPV of 20% is 6,970.
Okay.
Using
697.
20%.
Using 20%. Okay. Yes. Who else? Lesson.
Hello? Hello, sir.
I'm with you, sir.
Yeah, I used 20%. I got negative 6,926.
Okay, sir. So, okay, negative. So when you incorporate into your internal rate of return formula,
17.5.
17.5. So we have two testifier now on 20%. So who else have attempted before?
Same here.
Okay, another testifier. Yes, Mr. Friday.
Good morning, sir.
Good morning, ma.
Please, and when we are determining negative MPV, how are you going to know the exact percentage to use to arrive at a negative MPV?
Yes, the approach is called try and error method. So once you use 10% and you're having a positive value, you can use a higher value ranging from 15, 20, but don't go and use 99. I gave an assignment one day, somebody was using 90. Somebody was going far. Yes. So just look at a reasonable increment. If you use 15, you try, will you get a negative? If you use 17, you can use 18. Yes. So it's a try and error approach. Yes, but from calculations over time, it shows that when you solve and you determine your MPV to be positive based on the fact that you use 10% or 5%, it means for you to get a negative value, you will increase these rates, the rates you have. Just increase it by the margin of 5 or the margin of 10. Then you should be able to get a negative result. So where you don't have a negative result, you increase it again very fast. You do it very fast, but at least once you increase it by 5 or 10, definitely you're going to get a negative result. So it is called try and error approach. It's not that there is a standard form. So when you are in the exam hall, the fact that you are writing same exams does not mean that student A should use same rates that you are using. Do you understand? But once you use a particular rate that will give you negative results, your answer will come within the same range.
Okay. All right. Thank you, sir.
Yes. Can I hear from you?
Thank you, sir.
Yes. Who else have used another rate aside 20%? Yes, aside 20%. Who else? I'm seeing these hands up. Chikodili, do you want to speak to us?
Yes, sir. I use 20% and I got 17.5%. But there's the one I solve that I say that if you want to teach this, and I will ask you about it today. There's one I solved. That look at where I'm having confusion, but I think the confusion is clear now. When you get the negative MPV and you divide and you when you
Hello.
solve, I don't know how to put it, but when you get the negative MPV and you divide the positive and the negative, maybe you get 0 point something something. Where they will now add be the 20% minus 10%. My confusion is in that rate. Are we going to change it to decimal? Are we going to use it as normal percent?
Sorry, I didn't get the question.
That's what I'm trying to say.
Let me
Is
help
I
it?
you.
think I'm
Let me
clear
help
now.
her. Let me help her.
You use this. Okay.
You use that decimal direct to times this one we just did now. 21,115 divided by 28,041. We got
Yes.
7.53. You times it by 3. You times it by 10. That is that 20 minus 10. You times it by 10. Then you plus it by 10. You use that decimal direct to multiply.
Wait. That 10, am I going to change the 10 to decimal? Will I just
No.
times?
You times it like that. You use it direct.
Okay. Thank you.
All right. Thank you. So now, who else have used 20 anything aside 20%? Or some of you are not solving?
Sir,
Yes.
I use 15%. I got positive, so I have to quickly change it to 20% to get a negative NP.
Okay.
So,
All right. Okay, it's fine.
So I have a question.
All right. What is the question?
Okay, sorry. So for this positive MPV, so to calculate this MPV, my question is it whenever we get a positive MPV, we must also solve for the corresponding negative MPV?
No. It's when the question is asking you to solve for internal rate of return. Internal rate of return. Do you get?
Okay.
But once the question is asking you determine the MPV, all you just need to do is just to stop there. But we just want to use this question to solve for what? Internal rate of return. You get? So for you to solve for internal rate of return, you must use determine two discount factor and get one positive MPV and one negative MPV. Then you'll be able to substitute into your internal rate of return formula. You get?
Okay. Thank you, sir.
Okay, sir. I actually use a higher discount factor. I normally use a trick so that I don't have to come back and recalculate again. What I do is to add what I do to the first discount factor. If I have a positive MPV, I will add 3 to it. 10 plus 3, which is 13 times 2, which is 26. So in all indication, I must arrive at a negative NPV. So I don't have to come back again. So I use that and I got 16.5% as my IRR.
Okay. So you can see another trick again. So you can borrow from that likewise. So those that use 20%, our result was what? 17 point what?
17.5.
So you can see that it's not far from 16.5. You can see that. So once you are doing it right, your answer will always be within same range, and it will not be far from each other. So yeah, in this class, you don't know how to solve internal rate of return. Let me see your hand so that I don't want to, so that we don't need to solve this again.
Good morning, sir.
Good morning, sir.
Sorry, I used 20%. I'm still having a positive figure.
Okay, there's an issue with your calculation, sir. Check it again, sir. Check it again. Yeah. So yeah, in this class, you don't know how to solve internal rate of return. Adiza, are you raising up your hand?
Yeah.
You don't know how to solve internal rate of return. Okay. Let me use the 20% value so that we'll not waste time. So they will just give me their values. So we'll just see what to do. So that we'll move to the question we need to solve.
Network is dealing with me this morning.
So now, if our discount factor is 20%, using a higher rate, if our discount factor is 20%, in year one, the result will be what? Your discount factor will be what? 0. What? 0
833.
833. So in year two, it will be what?
0.694.
0.69. Okay, I want us to be consistent with 3%.
694, not 8. Shall go back.
Okay.
Remove your 8. It's
Okay,
694.
694. So in year three,
Year 3, 0.579.
579.
Sorry, Mr. Tope.
I can hear you, man.
Yeah, I used them 18% and I got 17.3%.
Okay, that is a negative value, right, of NPV.
Yes.
Okay, all right, fine. So for year 4,
482.
482. So when you multiply, you have what? 0.
49.
49.
980.
And in year
52.
Okay. Wait, 1 minute, please. 1 minute.
Okay.
So in year 2, you have what?
52,050. 050.
And in year 3,
28,950.
and in year 4,
12,050. 050.
so when you add
Negative 6,970.
697,
Yeah.
6970.
Yes.
So this is a negative NPV. So Hadiza, in your notebook, do you have this in your notebook, Hadiza?
Yes, sir.
So now, what is your A? Your A, comparing these two rates, 10% and 20%. Which one is the lower rate? 10%. 10%.
Yes,
Now, what is your A? Small letter A, the one with the positive NPV, right? So your positive NPV is what? The positive NPV.
Hello.
I can hear you. So your positive MPV is what? 21,115.
Yes, sir.
21,115, which is this A. Divide
Yes.
by what? Positive MPV, 21,115 minus negative MPV. Yes, take note of this minus. You know, there is the original calculation is minus. Now you are now
Yes.
having another minus, isn't it? You are now having another minus. So take note
Yes.
of that. So your
Okay.
your negative MPV is what? 6970, isn't it?
Yes, sir.
69 minus multiplied by minus will change to what? Positive.
Plus.
Will change to plus. So everything in this fraction multiplied by what? Your higher rate is what? 20, which is B. 20 minus your lower rate, which is 10.
10.
Then when you do that, you have what? So this will be equal to the lower rate is 10% plus what? Plus the value of A, which is what? 21,115. 21,115. Divide by what? 21,115
plus.
minus
Okay,
minus what? The value of 6970. 6970. All these, take note of this. So all these, when you complete that fraction, you multiply your results by what? What is your B?
10.
The higher rates, capital B, higher rates, that is 20 minus what? Minus 10. So when you simplify this, this will be what? Simplify. Take notes, this will change to positive. So let me change it to positive now. This will change to plus. So I believe you should be able to determine your answer from here. So for those that saw, what is our result? 17 point what?
17.5.
17.5.
17.5.
So if you solve appropriately, you get 17.5.
Sir, please, this is where I have an issue.
You said?
I said this is where I have an issue. My calculation did not give me 17.5.
Your calculator.
7.518.
7.518.
518.
Okay, that is what you have.
Yes, sir.
You add it plus 10, which is the lower root.
See this 10 here. Have you added this 10?
No, no, I haven't.
Right.
Okay. 10. Okay, 17.5.
So you solve it again and again so that you get used to it.
Thank you, sir.
All right.
Hello. This and in the formula you have A minus B. That's underneath. Why do you add it below in this when you are calculating 21 1 plus 6 9 70?
21,115.
Yes, plus
In
6
your
9.
book,
But the formula you have A minus B.
in your book, write what I'm saying now. Write it down in your book. Write 21,115 minus Then in brackets, put 6970. That 6970 in bracket is also a minus, right?
Yes.
So that minus multiplied by the original minus will give you what?
Okay, that's what you're talking about. Okay.
99,115.
Okay. So that is that for this. Let's move to something else.
Tope,
Yes?
sorry, please, how can we punch this on calculator? I'm not getting
No,
it.
you do it one after the other. I see this fraction. 21,115 plus 697 will give you what?
Plus. Okay, I'll do the denominator first.
Yeah, so that you just use that. Once you get that value, you put it one side. You now say 21,115 by the result of this addition here.
Okay.
And once you do that, you now come 20 minus 10 is 10. That result multiplied by this value here. You follow BODMAS. You treat this one first, then you multiply by the difference here. Then before you come to this addition.
Okay, now I get it. I get it, sir. Thank you.
All right. So let somebody read this question. What is the question? This question, somebody should read it. Yes. Somebody should read.
Aboki Limited is considering whether to set up a division to manufacture a new product, the Zico. The following statements have been prepared showing the projected profitability per unit of the new project as follows. Selling price 2,200, less direct labor 2 hours at 250 per hour. All this. A feasibility study recently undertaken at a cost of 5 million suggests that a selling price of 2,200 per vehicle should be set. At this price, it is expected that 10,000 units of vehicle would be sold each year. Demand for vehicle is expected to cease after 5 years. Direct labor and material costs would be incurred only for the durable of the product life. Overhead per unit have been calculated as follows. You can see it, variable overhead, rent, see note 1 below, manager salary, see note 2 below, blah blah blah. Depreciation, see note 3 below. 1. Vehicle would be manufactured in a factory rented specially for the purpose. Annual rental would be 800,000 payable only for as long as the factory was occupied. A manager would be employed to supervise project production of vehicles of a salary of 700,000 per annum. The manager is at present employed by Aboki Limited but is due to retire in the near future on an annual pension of 200,000 payable by the company. If he continued to be employed, his pension would not be paid during the period of his employment. His subsequent pension rights would not be affected. Manufacture of the Zico would require a specialized machine costing 25 million. The machine will be capable of producing Zico for an indefinite period. Although due to its specialized nature, it will not have any resale or scrap value when the production of Zico ceases. It is the policy of the Aboki Limited to provide depreciation on non-current assets using the straight line method. The annual charge of 5 million for the new machine is based on the life of 5 years, equal to the period during which Zico is expected to be produced. Aboki Limited allocates its head office fixed costs to all products at the rate of 1 125 naira per direct labor hour. Total head office fixed cost would not be affected by the introduction of the vehicle to the company range of products. The cost of capital of Aboki Limited is estimated at 5% per annum, and you may assume that all costs and prices given above will remain constant. All cash flow would arise at the end of each year, with the exception of the cost of machines, which would be payable immediately. The director of Aboki Limited are very confident about the accuracy of all the estimates given above, with the exception of those relating to product life, annual sales volume, and material cost per vehicle required. Calculate the net present value based on the estimates provided to show whether Aboki Limited should proceed with the manufacture of vehicles. B. Prepare a statement showing how sensitivity the net present value of the manufacturing vehicle is to error of estimation in each of the above factors: product life, annual sales volume, and material cost per vehicle. C. Assess the strength and weakness of sensitivity analysis as a method of evaluating risk and uncertainty in capital project appraisal. How does simulation provide an improvement over sensitivity analysis in this regard? Total mark, 30 marks.
Yeah, thank you very much. Looking at this question, even though I don't know what to do in other parts, at least this C part, you should be able to claim your 8 marks, even though not perfectly 8 marks, at least. Let's on the average, you should be able to claim 5 marks. Yes, because in PM and FM, we do discuss this issue of simulation and sensitivity. Yes. In the last diet, I produced that video. Yes. Well, sometimes students will be skeptical. What will happen? Will I be able to read everything? Will I be able to? But to me, yes, it's very difficult to put everything in our head, but at least just have an idea. Yes. So that when you see a question, you'll be able to build up on the idea that you have. Yes. Because once you read something, at least, and you see a question relating to that terminology that you read on, you'll be able to develop a point rather than not reading and just being blank. Yes, that one is very bad. So the theory aspects, try and just have an idea. It's very difficult to put everything on our head anyway, but at least have an idea of what they are saying. So now looking at this question, an interesting question. Now, when I saw this question after the exams and it was forwarded to me, immediately I view it. I know number one thing, if I'm to be in that situation of the exam, I know number one thing I will do is to get my contribution, because this information here is already leading me to that. This information here. So as you walk into the exam hall and you see information like this, you see selling price, you see variable costs, you should know that get contribution. The question will not even tell you to get it, but as part of your workings, show it. Show it as part of your workings. Now, this question is a combination of relevant costs. Yes. So your knowledge of relevant cost is important to solve this question. You can see how they can link issues of performance management with issues of financial management. And because this investment appraisal is also a topic in performance management. So the question is, for you to determine or invest or appraise a project, you must ask yourself, what are the relevant costs? What are the relevant costs? This is very important. What are the relevant costs associated with this project? And that is why the issue of relevant cost is coming in this question. And the issue of relevant cost is very important in investment appraisal. It's not every cost you incorporate into your calculation. You incorporate into your calculation. So as you read, you ask yourself, what are the relevant costs? So there's what we call relevant cash flow for capital investments. While we're doing the normal classes, I've discussed this relevant cash flow for capital investment decision. We have two types of cash flow that you know. We have cash inflow and cash outflow. Cash inflow and cash outflow. While we were solving our MPV, we have two scenarios. We have our cash outflow at year 0. Then we have our cash inflow for year 1, year 2, year 3, year 4. The difference between your present value of cash inflow and your present value of cash outflow will give you what? Your net present value, which is what has played out in our computation of MPV that you've seen there. So now, cash flow is one of the variables required in determining the financial viability of a project. That is using discounting techniques such as MPV and internal rate of return. Now, the question is, what are relevant cash flows? What are relevant cash flows? Relevant cash flows. 1, variable cost. I don't want to waste my time on this. Variable cost. They are relevant cash flows. They are relevant costs. Why? Because they can directly be attributable to activity level. So it means as activity changes, the variable cost also changes likewise. Now, the question is, what of fixed cost or fixed overhead? Fixed cost or fixed overhead. I recall during the normal classes, I use a phrase that these are costs that have no sympathy for activity level. It means that if the activity level reduce, you will still pay the fixed amount. If the activity level increase, you will still pay the original amount. So it means that the fixed cost, the fixed overhead, they do not change. So irrespective of the number of units produced, fixed cost does not change. So if fixed cost does not change, is it a relevant cost or irrelevant cost? Can I get a response?
It's irrelevant.
Irrelevant. So fixed cost is an irrelevant cost and should be what? Ignored.
Ignore.
Except where there is an incremental value. Where there is an incremental value. When the fixed cost is this, but because you want to increase your production, your activity level, you need additional value of fixed cost. Based on that increase, the additional cost you incur will be relevant at that point. Please, can you hear me?
Very well, sir.
Okay, I can see a message that my line is breaking. That is why I have to ask that. So now, another point that you need to observe in issue of relevant cost is depreciation or amortization. We need to ask ourselves, whenever we see depreciation and amortization, are they relevant costs? Let me ask, because I've treated this in PM.
Not relevant. Irrelevant.
Yes. So why are those
They are
not
not
relevant?
cash. They are not
They are
cash
not cash
items.
Yeah, they are not cash items. Madam Chikodili, you deserve a sweet, right? I will send sweets to you. You take chocolate, right?
The sweet is for me to pass FM and go to professional.
Stick sweet.
All right. Don't worry, you will pass. Yes. Everybody have been putting all effort in place. We will pass by the grace of God. So, so depreciation. This is a non-cash item, and does not involve the movement of cash. So depreciation is an irrelevant cost and should be ignored. It should be ignored. So now, what of opportunity cost? Opportunity cost. Opportunity cost. Opportunity cost is a relevant cost, isn't it? The sacrifice that is being forgone. That is being forgone. Opportunity cost. What of sunk cost?
Is it relevant?
So,
Is it relevant past cost?
yes, these are past costs that already been incurred. So they are historical costs which have no impact in making future decisions. So now, looking at this question, I actually highlighted all these relevant cost issues because once you read this question, you'll see them playing out in the question. So now, to solve this question now, first, we need to calculate or determine our cash flow. Our cash flow. And for us to determine our cash flow, we need to determine our contribution. We need to determine our contribution. Once we determine our contribution, then we'll look at the question, do we have relevant cash outflows? Relevant cash outflows associated with our decision, Once we do that, then we're making progress. So the first step is for us to calculate our net cash flows. Our net cash flows. And how are we going to do that? Solution. We have it. The business name is what? Aboki Limited. Who is Aboki? I want to ask, what is the meaning of Aboki?
Friend.
My friend.
Friend.
Our
Very
friend.
good. See, all of you.
Sir, please, this question is which year?
It's just last year, November, the first financial management exams. The first one. So Aboki is friend. I thought somebody would tell me something else. So Aboki is friend. That is Aboki. So Aboki Limited. That is the business. Calculation of net cash flows. Now, for you to calculate your net cash flows, what will you do? When we say net cash flow, let's even understand this English. What is net cash flow? What is net cash flow?
The inflow minus the outflow.
Very good. Yes, the difference between your inflow and outflow. Now, first, we need to get our contribution. The contribution will be our what? Our inflow. Will be our inflow. So, for you to get your contribution, please hope you have the question. Or let me send it to the group. Or if you have the question, just question one. Question one.
Which year, sir?
It's just the first November 2025.
Okay, sorry.
That was the first. I think Hadiza forwarded it to the group, or somebody forwarded it to the group some time ago. FM. So just open it, you see it. So to get your contribution, what will be the first thing? To get our contribution.
Selling price.
Determine our selling price.
Selling price. Selling price. Selling price. Selling price. Now, the selling price.
Sir, please send the question on the group, please.
Okay, somebody should help me, please. Somebody should help me. Just forward that document again to the group. The group is open. So from the question, the selling price is what? For 1 unit. Take note, this is for 1 unit. 2,200. Take note, this information is just for 1 unit. So let's just get for 1 unit and see how to forge ahead. So the selling price per unit is what? 2,200. 2,200. Now, our variable costs are what? Variable costs.
We have the direct labor, direct material, and overhead.
Sure. We will know if overhead is part of it.
Yes, some of overhead are part, but not all.
All right. So less variable cost. Less variable cost. Less variable cost. The variable costs you have, we have direct labor. The value is what? 500. Which other variable costs? We have material. Material. The value is what? 450. The value is 450. From the question, 450. Now, overheads. This overhead, they are not specific. Either it is variable or fixed. So what will you do? Do we have any additional information?
Yes, sir.
Any additional information? Okay, fine. This is it. Overheads per unit have been calculated as follows. As follows. Variable overhead. This is defined now. It is defined. Most times, students think overhead are always variable, but overhead is a collective name that in that overhead, you can have variable, you can have fixed. So you need to ask yourself, is this overhead specific or not? So now, breaking down this 1,150 is this analysis here. This analysis here. This analysis. That's variable overhead, clearly defined, is what? 250. It means all these other ones, rent is an overhead, but it is what? Fixed. It is constant over a period of time. So it does not change with activity level, with production. Manager's salary, it is what? It is fixed. Your salary does not change like that. So for those of you that were in the flexible budget class in PM, you will see that question on supervisor's salary, where they say it is step function. It is a step cost. So you can see that playing out, that whenever you see salary, it can be stepped, it can be fixed over a period. After some time, it will change. So you can see that it is not variable, but rather fixed. So depreciation too, head office cost, you can see. So now, the variable cost we need to get our contribution is what? Variable overhead, 250. 250. So we have it as variable overhead. Variable overhead is what? 250. So your total variable cost will give you what? Total variable cost 1,200. So your selling price less variable cost will give you a contribution of what?
1,000.
Contribution of 1,000. This 1,000 is contribution per what? Per unit. Isn't it? Per unit. In the question, how many units are you planning to produce? From the question.
10,000.
10,000 units.
So this is it. It is expected that 10,000 units of Zinco will be sold each year. So if you are making contribution of 1,000 on 1 unit, on 10,000 units, what will be your total contribution? On 10,000 units, what will be your total contribution?
10 million. 10 million.
10 million. 10 million. So you follow it gradually in this order. You follow it. So when you see a question and there is a long paragraph, when you see a question and there is much paragraph, just follow it line by line. Pick the information you need. I want to tell you that if you've been following this class, there is no question that will come that you will not be able to at least attempt to a reasonable extent. Pick the information you need. Take the information you need and solve. Don't begin to doubt yourself in the hall. Yes, it's when you begin to doubt yourself, you just give up. Yes, don't doubt yourself. Don't doubt yourself. Do what you know. Do what your spirit is telling you to do. Yes, it's when you're beginning to doubt yourself. So as you do those things, make sure at least you gather momentum and write very well. So number of units produced and sold is what? Number of units produced and sold is what? 10,000 units. 10,000 units. Now, what will be your total contribution? Total contribution. If you are producing 10,000 units and per unit contribution is 1,000, your total contribution will be what?
10 million.
10 million. 10 million. So this is your inflow. This is expected to be what? Your inflow. Your inflow. Now, what are the likely outflows from this question? Let's go and see the likely outflows that Zinco will be manufactured in a factory rented specially for the purpose. Annual rental will be what? Will be 800,000 payable only for as long as the factory was occupied. Is this rent, the rent here, is it relevant or not?
Relevant.
No.
Relevant.
It's relevant.
Relevant, sir.
Why is it relevant?
Because it's for the purpose of the production.
Very good. For the purpose of the production. Without this production, we will not incur this cost. So this rent is relevant because we have to incur it for us to produce Zinco, for us to manufacture Zinco. So where we are not producing Zinco, there will be no need for us to incur this cost. So this is a cost associated with the decision we want to take now. But it will not be relevant if it is a past cost. It will not be relevant if we are not going to incur it based on this production. But because this production requires another factory, then at that point, it is relevant. So for subsequent production, it might not be relevant again. You understand? But because this is the first time, it is relevant. It is relevant. It is relevant. So now, it means our outflow, one of the outflow in this question that is relevant will be what? Will be rent. Will be rent. Rent. Let me just present it this way first.
I'll be raising my hand.
Okay, what is your question, sir? I'm not checking the. Yes?
One of the mistakes I think I made during the exam, these are, you told us earlier that whenever we see something in brackets, you take notes. So this direct labor and material, nothing happened to these 2 hours at 250 naira in bracket. Sorry, maybe I
So this
wasn't.
is it, sir. Something is happening to it. Something is happening to it. For you to get 500, what will you do? 2 hours. You need 2 hours to produce 1 unit. How much are you paying per
Okay,
hour?
2 times 250, 500. Okay, okay. Okay, I was dividing it then. Okay.
So now, for material, for you to produce, you need how many kg? 3 kg, isn't it? How much are you paying per kg?
50 or 3 times. I was doing division. Sorry, it's okay, sir.
All right, sir. So now, one of our relevant outflow in terms of expense is rents, which is 800,000. 800,000. What else do we have as an expense? Let's read. A manager would be employed. A manager would be employed to supervise production of Zinco at a salary of what? 700,000 naira per annum. At a salary of 700,000 naira per annum. I know you already know that this salary will be a relevant cost.
Yes.
But there are other information attached to it per annum. The manager is at present employed by Aboki Limited. It means the manager that is to be employed is currently under the operation of Aboki Limited, but is due to retire in the near future. Is due to retire in the near future. Is due to retire in the near future on an annual pension of what? 200,000 naira payable by the company. If he continued to be employed, his pension will not be paid during the period of his employment. His pension will not be paid during the period of his employment. His subsequent pension rights will not be affected. So the question now is, what will be the relevant cost?
Should be 200 like future expenses.
500.
Okay. Okay. So Ma, why is it 500?
Because the 200,000 that the company is supposed to be paid will be saved. So we use it to reduce the 700,000 that was supposed to be paid as salary for the production of Zinco.
Okay, that is very good. Yes. Can I get another school of thought? Yes. It's correct, but I just need more ideas so that when you see such, yes, you must be able to interpret questions. He said somebody should. I'm making noise in my class. Yes, results.
Hey, sir. Good morning, sir. Sir, please, I want to ask a question. I'm confused here. They said the manager will be employed to supervise production of Zinco at 700,000 naira per annum. Why
Yes,
is it that we are considering 200,000 naira? Meanwhile, he's going to supervise Zinco Limited, but 200,000 naira has to do with Layer Limited. I'm thinking in my mind that it's the 700,000 naira that should be relevant because it has to do with he's being employed to supervise the project at Zinco. I don't understand. So please, can you help to enlighten me on that? Thank you, sir.
you mentioned a name. Is it Layer Limited?
Yes, that is what is in the hard copy of the question. The manager is presently employed by Lear Limited, not Aboki
Yeah.
Limited.
Okay. Okay. I'm using what is in the soft copy. This so I know I didn't see Layer Limited in my in this write-up. I have to ask.
Zinco. Anyways, I think. Hello, sir.
Yes, I'm with you. Speak.
I think opportunity cost play a role here.
Yes.
I don't know. So it's opportunity cost here now, and the opportunity cost is relevant. So the manager have to lose the pension if he want to still continue as a manager of an employee of Aboki Limited. That's how I understand it.
No, your understanding is
Okay,
correct.
sir. Adding to what you've just said, if we're taking only the relevant cost for this particular transaction, what we'll be needing on this one is just the salary of the manager that Zenko will pay. I think that's what is important in this additional information too. Every other thing seems to be off the Zinco production.
Sorry,
I
if I would
concur with
add, sir,
Mary too.
if I would add, sir, if with what they said they have on the hard copy, like they said, the manager is an employee of Lear, then the 200 will not be relevant. But with what we have here, the 200 is relevant to as a savings to the production of Zinco.
All right. Thank you very much.
But the 200 is he'll be paid in future. He's being paid 700 to supervise. I'm just thinking, why are we considering the 200? Because it's not related directly to what he's doing now. He's going to be paid a salary of 700. Then in the future, 200. Don't know how it's a savings.
So this is it. The manager will retire even while still working for Aboki. Though I'm not working with Layer, I'm working with what I have on my screen. Though it will still lead us to the same result, but I don't want to start looking for where Layer is now. I just want to follow what I have on the screen. Yes. So now this is it. The relevant cost will be what you pay with the decision. What are we paying now? If we are to make this decision, what are we going to pay? 700,000, isn't it? 700,000. Since there's an opportunity cost that the manager will need to sacrifice, we need to sacrifice 200,000 because he's going to retire even while still working as a supervisor. And while still working as a supervisor, he's going to sacrifice how much? 200,000. So if the manager is not working currently for Aboki, we'll just pay him what? We'll pay him.
700.
We'll pay him 700. The relevant cost is this: what you pay with the decision, that is 700, less what you pay without the decision. Now, if the supervisor is not working currently, what are we going to be paying him? The pension, right? The pension. The pension. So the point is this: the company will only incur an additional 500 by keeping the manager. The additional 500 is what the company will incur, and not the full 700, because the 200,000 naira, the 200,000 naira pension will be paid. So what is relevant to this decision now? What is relevant to this decision now will be 700,000 less the 200,000. That is the sacrifice the manager will bear. And what is that sacrifice? The 200 naira is going to lose even while working. So the relevant cost will be determined by adjusting what? By adjusting the pension, which will be 700,000 naira less what? The 200,000 naira. Less the 200,000 naira. So what are you losing by working as a manager? Instead of you getting your 200,000, you won't get it. You won't get it. So the opportunity cost here will be what? Will be the 200,000 naira that is being saved. This is a saving. This is a savings. So the relevant cost here is the incremental cost, which is 500,000 naira, and that is 700,000 less 200,000, and that will be the relevant cost. I don't know if this is clear. I know this is sometimes confusing. Is this clear, please?
Yes, sir.
So based on the, please, you can revisit the issue of relevant cost, should in case, and see how, when you have two decisions to make, what will be the relevant cost? So now, based on this, the relevant cost of supervision or salary, the relevant cost of salary will be 700,000 less what? 200,000. And this will give us what? 500,000. Now let's go through the question again. Do we have any other issues associated with cost? Manufacture of Zinco will require a specialized machine costing 25 million. The machine will be capable of producing Zinco for an indefinite period, although due to its specialized nature, it will not have any resale or scrap value when the production of Zinco ceases. It is the policy of Aboki Limited to provide depreciation of non-current assets using the straight line method. The annual charge of 5 million naira for the new machine is based on a life of 5 years, and 5 years equal to the period during which Zinco is expected to be produced. So this is an outflow in terms of what? Capital investment. It means for us to produce this machine, we need to invest For us to produce Zinco, we need to invest in a machine that costs what? 25 million. 25 million. 25 million. So this is not in relation to the net cash flow that we want to get for now. We're going to, it's not related to the net cash flow that we want to get for now, but it is related for us to determine our NPV. This will be our initial outlay to determine our NPV. Aboki Limited allocates its head office fees cost to all products at the rate of 125 naira per direct labor hour. Total head office fees cost would not be affected by the introduction of Zinco to the company's range of products. So is this a relevant cost?
No.
Irrelevant.
So the statement is just there. So one thing you will definitely be sure of, there are some statements in relevant cost questions that must be read as so the Monkey Limited is estimated at what? 5% per annum. So this 5% per annum will serve as what when you want to compute your NPV? We serve as
àwọn ti jẹun tó ń pa ó ti jẹun ẹnu tẹ́yà mọ̀ wí tẹ́yà sílẹ̀ ẹsẹ̀ fún mi tẹ́tí fún mi ti fi bàbá náà lẹ̀ slow so kí wàá lẹ́bi charge nígbà yẹn àkókò méjì lọ.
Wetin dey happen?
Kí wàá fẹ́ mo gbá ń lé.
I'm trying to mute him.
Náà mi ti wá.
Okay. Anytime you're having a class and you are not asked to talk, just mute yourself. It's a very simple thing. They've put the technology there, everything. Just mute yourself. So now, based on the question, I'm asking that this cost of capital of Aboki Limited of 5% per annum will serve as what?
Discount factor.
Discount factor.
So did you see where these people came and hide this thing? Hello. Am I still in? See what they did now? Cost of capital. After all these long stories, they came at the last paragraph and put that discounting factor, cost of capital, 5%. These people, eh?
Yeah, they are my people, and they will still join us. So the point is this: just as you go, just that confidence should just be there. Yes, once you see 2 pages question, tell it is a lie, you will solve it. Yes. The point is, you might not be perfect, but at least based on the understanding you have, if you are in the hall now and you know that this 25 million is an initial outlay, draw your NPV table. Yeah. Details, yeah. Cash flow, discount factor, PV. Put that there. Then, if you can reason anything as your cash inflows within those periods, put it there likewise. And so, at least they will know you've done something. If it is 1 mark, I've seen somebody that is having 49. That 1 mark would have allowed him to or her to cross. I've seen somebody having 45. You understand? And that can be so demoralizing. Yes. So some of these things can actually add to the max when it is being added up. Yes. So don't just leave questions like that. And so that is not that is the cost of capital, the discount factor you have to use. Now, based on this now, what would be our net cash flow so that we'll conclude this? What will be our net cash flow? Since our inflow is 10 million, our outflows, we have 800,000, we have 500,000. What will be our net cash flow? So let me just do this again. Net cash flow will be what? Total contribution. Total contribution will be equal to what? That is 10 million. Your outflows, you have rent. The rent is what? The rent is 800,000. 800,000. And what else? You have your salary. The salary is what? It's 500. So when you do this, what will be the outcome? Your net cash flow will be what? Your net cash flow.
87. 87.
87. 87. So net cash flow. So it means every year, what you are expected to be getting is what? 8,700,000. That is your expectation yearly. This is your annual cash flow. Annual cash flows. Now the question I'll ask, how many years will this project last? How many years?
5 years. 5 years.
5 years. Where is this stated in the question?
Paragraph 3.
Number 3.
See it, the annual charge. Okay, life of 5 years equal to the period which Zinco is expected to be produced, 5 years. So with this information now, can you solve for your MPV? Can we try? Can we solve for MPV? Everybody, let's try. You know, you have your initial outlay to be what? The initial outlay will be what? 25 million. Your inflow, annual inflow, is expected to be what? 8,700,000. So if this project would last for 5 years, what would be your MPV? Everybody, let's solve. Let's solve. You have the variables already, so solve.
Mister, what's the rate? The rate of capital.
We analyze it
5%.
together with 2 people.
5%.
My oga said they hide it. So let's solve. You know, this is the exam. This is part of the exam. It's what you know that you go and write in the hall. So solve.
I can't see the question. What is the initial outlay, the cost of the investment?
I got a positive NPV of 12,000.
12,626,300.
Yes.
Okay, fine. So this is the initial outlay, 25 million for the person asking. Yes. So you see, you've gotten how many marks now? So they say 16 marks. Don't allow the marks allocated to you to scare you. When you see 16 marks, you think it's one big thing they ask you to do. You now
Sir,
say, yes.
this 87 that we got, the annual cash flow, are you going to use it for whole year?
Yes, year 1, year 2, year 3. But you can, since it's constant, you can use annuity. You understand?
Okay.
Or if you know
Okay,
annuity
sir.
will confuse you, do what you can do and get your answer. You understand?
All right,
That
sir.
is the major thing. So, Priest, I'm waiting for your answer. 12 sixes. Okay, Madam Mary, I can
12,662,300.
see from the chat 12666. Yes, miss 3 marks. Let's say you have 12 marks now. 12 marks. So let's show it because some persons might not be on the same page that we are. So PV, we have it as what? Calculation. Net present value. Net present value. That is NPV. NPV. So your initial outlay is what? Initial outlay, which is year 0, is what? How much are you giving out?
25 million.
25 million. Your discount factor at 5%. For year 0, it will definitely be what? Always be 1. I've explained why this is always 1 over time. So now, your PV, the present value for the initial outlay will still be what? 1 multiplied by 25 million, still negative 25 million. So your annual cash inflows will now be what? Annual cash inflows. Annual cash inflows. I will do annuity, year 1 to 5. So it is expected that you have 8,700,000 every year. So when you apply annuity, what will be your discount factor?
4.329.
4.329. So your present value will now be what? 4.329 multiplied by 8,700,000. You have what?
$37 million. Hello, sir.
Yes, 37 million. I'm writing.
662,000.
662,000.
300.
Like something like this, right?
Yes, sir.
37 million, 662. So the difference between these, your positive value, based on your annual cash inflow and your outflow,
12 million.
12 million.
662, 300.
662.
300.
Yes, let me say that I know there will be some little discrepancies. Some persons have solved by approximating, right, to 4.33. Yes, I know some persons have solved. You observe some little difference. That is not an issue. Yes, you observe some little difference. That is not
Hello, sir.
I can hear you.
I got 12,671,000. My NPV
12 million.
671,000.
671.
Yes.
Yes, yes, that is also fine. Yes.
Okay.
You know, how did you apply this? You approximated
I didn't use
this.
annuity. I use the normal discount. Yes.
Okay, fine, fine. So that's an approach that you adopted. You see those discount
Yes.
value you have. When you
Yes,
add
sir.
everything, when you have those discount value, you should have this 4.329 approximately. Yes.
Okay. Let
Just
me
add
add
it
them.
up and add them up. You see what will happen. Because of time, I don't want to go into those details. Yes. So when you add those values from your year one, add those 0 point this, 0 point that, add them up. You should come up to something close to this. Yes. So this is our MPV. This is our MPV. So what would be your advice?
Sorry, sir. My MPV when I got here is 11,000. Yes, 11,799.9.
Sir, what have you done, sir? Tell me
I
what
use
happened.
I not use the annuity. I use the normal MPV rate.
Tell me, how did you use the normal MPV rate, sir?
Okay, my outlay now. My outlay, I'll use this discount factor of let's 5%. Then I ate at the discount factor of 5%. I multiply by 8,500 for a one down to a five. When I sum it up, it will give me 36,799.9. Then less from the 25 outlay.
Snap it. Yeah, show it on WhatsApp.
Okay.
Share it with me on WhatsApp.
Okay.
Decision.
Hello, sir. Hello, sir. Yeah, no,
Yes, sir.
I got it now. But during the exam, what of that? I made use of that depreciation, but nothing was done with it now. That paragraph. Hello?
What did he say about depreciation?
Yeah, I said, though I've gotten it now, but in the exam, I was struggling what to do with that depreciation they wrote there, the annual charge. I didn't know how I worked it. Does it mean that annual charge?
Yes, they are not relevant, sir.
Okay.
They are not relevant. So anytime you see depreciation, amortization, they are not cash items. So anytime you are solving questions on MPV,
I was talking about when I was doing the calculation of PV. That was where I wanted to remove it from the cash flow.
Okay.
Yeah, I was struggling with it. It's okay.
But it's fine now, sir.
Yes.
All right. So what will be your advice to Aboki based on these your results?
Should accept the project because it gives the positive NPV.
So with the net present value of 12,662,300, which is positive, Aboki Limited should proceed to manufacture the products Zinco. Aboki should proceed to manufacture Zinco. Please, this 16 marks free of charge. Can you solve it again on your own after the class? At least get used to it. Yes, solve it again on your own. Then
Hello, sir. Please, I want to ask you a question.
All right, I can hear you, ma.
Okay, so I want to ask, aside from the tricks of this irrelevant course and relevant course that I can use this to set questions as regarding MPV, are there other aspects that can be that they can also use to set MPV that we're not familiar with yet? Because I know I can does not repeat questions, so they might use this relevant and irrelevant course for last year, and then this year they might switch to another maybe topic also, but relating it down to this MPV. I don't know if there's any other
Yes,
thing, maybe
that is
maybe
why.
capital allowance, all those parts. If
Yes,
we can
that is why.
explore that.
Yes, that is why I'm still referring you back. My mind is on that what we've done in class. That is what my spirit is leading me to.
Okay.
That's what we've done in class. That is the angle me I'm looking at. Yes, that is the angle I'm looking at. Then the revision of last diet, I will still forward it again. Is on that same line, that same approach. In that revision of last diet, we solved the question in the pilot question. Yes, the revision in the question in the pilot question that has to do with MPV of this of another form. Yes, so I'm looking at that angle. Yes, that is where I'm looking at. So that is why I'm referring you back to that aspect where they can bring the issue of capital allowance. Yes, so you settle down, analyze that again on your own. Yes, because that is the angle I'm looking at, that they might want to come up these diets. Yes, but still, this knowledge is also very important. They might we might say they don't repeat and they come up again. Yes, so that we not look at see. I've seen this thing before. I don't like that kind of statement. At least anything I'm seeing, let me have an idea about it. So, but please, the question we treated during the class, and I also forward the revision for last diet on this topic so that you see what we've done. That is very important. So that at least you should be very okay and be comfortable with this topic. So I'll reshare on the platform when I'm through.
So I've sent it to a platform.
Hello, sir.
Yes.
Please, I have a question. This the information in number 2. We are in
Yes.
our whole hard copy here. It says the manager is at present employed by Layer Limited. And in the one with you, it said Habuki Limited. So I want to ask, the decision taken here, does it still remain the same? Or due to
Yes.
the okay, all right.
I think it's a mistake. I think the hard copy, I think it's a mistake. There is a
Okay.
mistake somewhere. Yes. For those of you that have in the hard copy you have, is it the past question?
Yes, sir. Yes, sir. The past question of
The,
last diet.
the one given to you in the hall.
Yes, sir. Yes,
Yes,
sir.
sir. Yes.
Okay. I don't know why there is a mix-up anyway, but the
So,
decision is
sir,
still.
okay, we will start to look for who is layer in this situation now, so to determine what to do with this
There is
information.
a mix-up, yes, and definitely there can be typographical error. Even maybe when they were not giving us this is also from them. So maybe they have to quickly correct certain things, but the decision is same.
Okay, sir. Thank you.
Yes.
Hello,
So,
sir.
yes.
Hello, sir. Sorry to draw you back. My network threw me out when you were trying to explain something about capital allowance. Please, I would like you to do a recap.
No, I was just saying that if you observe the question we solved in class, during the normal classes, we solved a question that involved capital allowance, whereby the question we even talked about issue of tax savings, that tax is paid in arrears. You understand? Then when you have capital allowance, the capital allowance will move in line with the tax, because the essence of capital allowance is to reduce the amount of tax you will pay. So
Yeah.
I'm saying that let's go back to that question, that they might come in that form. Yes, they might come in that form. At least, anyhow they are coming, let's be very okay and comfortable. You understand? So that is what we talk about.
Thank you, sir.
So let's move further to see. Now, the next is 16 marks free of charge. The next is B. Prepare a statement showing how sensitive the net present value of manufacturing Zinco is to errors of estimation in each of the three factors.
Hello, sir.
What is the question? What is your question? If you want to do a low, sir, let me finish what I'm reading. Or you put your statement in the chat box. Somebody can respond to you. So prepare a statement showing how sensitive the net present value of manufacturing Zinco is to errors of estimation in each of the three factors. What are the factors? Product life, annual sales volume, material costs per Zinco, product life, annual sales volume, material costs per Zinco. Now, this is sensitivity. And for you to solve question on sensitivity, you need to know the formula. Once you know the formula, you'll be able to solve with ease. How many of you watched the video I forwarded yesterday on sensitivity analysis? I know Madam Mary she has watched it because she's talking about the assignment there. Yes. Okay. I can see. Yes. Okay, fine. Fine. So sensitivity analysis. Sensitivity analysis. When we talk about sensitivity analysis, this is also a technique that is used in capital budgeting to test how much a key variable can change. How much a key variable can change before a project decision change. That is, how sensitive is the project to changes? How sensitive a project is to changes in terms of sales volume, selling price, variable cost, fixed cost. It means if variable cost should change, what will be the effect on the project? If fixed cost should change, what will be the effect on your decision? So this is the issue of sensitivity. Now, based on this question, that we should determine sensitivity of the project life. Now, to determine sensitivity of the project life, what are we going to do? The formula will be what? Please write it down. The formula will be the relevant life of the project. Relevant life of the project. Less the break-even point of project life. Let's break it. Okay, let me write it too. Break-even point of project life. In brackets, that break-even point of project life, what they want you to do is to calculate the discounted payback period. The discounted payback period at that point. sensitivity. So sensitivity to project life. To project life. This will be what? Relevant life. Less what? Break even point of project life. Break even point of project life. This can be a discounted payback period. Discounted payback period. Payback period. Discounted payback period. Divide by relevant life. Divide by relevant life. Divide by relevant life. Divide by relevant life. Relevant life. Divide by relevant life. I'm using relevant life in this case because of a reason. Because since it's sensitivity to project life, and we are to use break-even points of the project life. The question I want to ask now is, what will be the break-even point of the project life? That is one thing we must know. What will be the break-even point of the project life? If break-even point of project life is discounted payback period, can anybody try? What will be the break-even point of the project life? Yes, I need us to try. Because I've given a clue already of discounted payback period. So when you say break-even point, what is break-even point?
It's fixed costs over contribution.
That is cost volume profit analysis. Okay. But on a general note, when you say something is break-even, what are we referring?
When the
The
business
point at which there is no
profit or loss.
and no loss.
No loss, yeah.
Very
Break
good.
even.
Very good. When there is neither profit nor loss, that is break-even. Now, in payback period, what are we doing? When you give out 25 million, in payback period, what will you be looking at? The time you will recover your 25 million, right? The time you will recover your 25 million.
Yes.
So that point to recover your 25 million minus the 25 million you've given out. 25 million out, 25 million in. When you do the plus and minus, it will be what? Zero.
Break even.
It will be zero, which is break even. Which is break even. So the relevant life or sensitivity to project life, the formula is relevant life less break even points. Break even point of the project life divided by the relevant life. Yes, I'm seeing these hands up. Any question? Inform. What is your question? I'm seeing this hand again. Ike Chuku. What is the question?
Good morning, sir.
Good morning.
Sir, so, sir, the question I was having, there's a time, is a question, sir. We explained about overhead. So the question I wanted to ask, in the question, let's assume the overhead is just given without specifying if it is fixed or variable overhead. So how do we treat that in
There will be
exam
an
position?
additional information to make it more clearer, which is what these questions have done.
Okay, sir.
So there will be an additional information. It's now left for us to know what the additional information is saying in relation to the overhead.
Okay, sir. Thank you, sir.
So now, going by this formula, the relevant life less break-even point of the project life divided by relevant life will be what? We need to determine our break-even points of the product, or of the project life. And how do we do that? This is just the only working we need here. This is just the only working we need here. So the break-even point of the project life will be what? Will be what? That is the question. Will be what? So let's go and show it. You know, this is called discounted payback period. So what are we going to do? Let's show it. Break-even point. Break-even point of project life. Of project life. Break-even point of project life. So we have the
Hello, sir.
year. Yes, sir.
Okay, I got 8.2 for the discounted payback.
8.2?
8.2 years. 8.2 years. Sorry, 3.2 years.
Yes, very fine. Yeah, that is it. 3.2 years. So the cash flow, then we have the discount factor at 5%. Then we have the present value. Then let's say cumulative present value, cumulative PV. So the first year, that is your year 0, you are giving out as an outflow of what? Of 25. Let's suspend the zeros up. Suspend the zeros up.
So it's 2 years closure.
No problem, now we'll see it. So now, for year 0, the discount factor will be 1. Your present value will be what? 25. Your cumulative, 25 plus 0 to be 25. Now, in year 1, there'll be an inflow. Your inflow will be what? Your 8.7 that you have in year 1. That is 8,700. Your discount factor will be what? Adiza?
0.952.
952, right? So
Yes, sir.
when you multiply by 87, you have what?
8,282,400.
8282.
400.
Okay, we should go by the full concept, right? Instead of
yes, sir.
reducing it. All right, so let's do it. Let's have it that way. Have it that way. So when you have it this way, so when you multiply, okay, so now you invested 25 million. In the first year, you recovered what? 8,282,400. How much do you have left to recoup?
16,716,600.
16,716.
717,600.
717,600. So it means you are still yet to recover this value. In year 2, still our inflow 8,700,000. What will be our discount factor?
0.907.
0.907. When you multiply that by 8.7,
7,890,900.
890,900. So since you have this inflow in second year, it will reduce this 16,717 to how much?
8,826,700.
8,826,700.
Yes, sir. 700.
So you still have this pending. Now in year 3, you have inflow of 8,700,000. What will be your discount factor?
0.864.
864. When you multiply, your PV will be what?
7,516,800.
7,516,800. Now, this is what you have in the third year. It will reduce this value to what?
1,309,900.
1,309,900, right?
Yes, sir.
So it means these will lapse into the fourth year, but it will not take the whole of the fourth year before you recover it. So what will happen? The fourth year, let's see, our inflow will still be 8. What will be your discount factor here?
0.823.
0.823. When you multiply, you have what?
7,160,100.
7,160,100. So based on this, what will be your payback?
3 years plus 1,309,900 divided by 7,160,100.
Okay. So we've shown a payback approach before now. Payback period will be 3 plus the shortfall is 1,309,900 divided by the next inflow, which is
160,100.
160,100. So when you divide that to give you the number of periods, then you can multiply that by 12 to have the months perfectly. So when you do that, you have what?
3.2 years.
So the payback period will be 3.2 years. 3.2 years. Now, what is one of the disadvantage of payback period?
It doesn't take into consideration the time value of money. And then this cash flow, it doesn't take into consideration the remaining cash flow after it recovered the amount invested.
Yes. Yes. So that is just it. I'm asking this question for a particular reason. Because, in the question, the project life is how many years? It's 5.
5 years.
5 years. But now that we're trying to use discounted payback period to determine our project life, what will happen? What will happen? The relevant years will be what?
3.2 years.
3.2.
No, that 3.2 is the break-even point of project life. Break-even point.
5 years. 5 years. The relevant years is 5 years. It's 4 years.
This is where the confusion is coming. And that is why I asked that question. That is why I asked that question. So now, the relevant year will be what? Based on the concept of this payback period.
3 years. 4 years, because it's only 4 years we took consideration of.
Yes, it's 4 years. The relevant years will be 4 years. You understand? Because the shortfall lapsed into the what? Into the 4th year. So the relevant year will be 4 years. 4 years. 4 years. But the break-even point of the project life, the break-even point of the project life is how many years? 3.2. 3.2 years. This is at the point whereby your outflow equals your inflow. Equals your inflow. So based on this, what would be the sensitivity to project life? The sensitivity, it will be 4 minus what? 3.2 divided by what? Divided by 4. So what will be the outcome?
20%.
Multiplied by 100. So it will be 20%. Though there are different school of thought to this. Yes, there are different school of thought to this. In some school of thoughts, we still use 5. Yes, but based on the concept of payback period, because payback period does not consider any other years after you've recouped back the money. So that is why we have to restrict it, and that is why I have to define the formula. Relevant life is 4 years. Is 4 years. Some school of thoughts we use 5. We use 5. That is the whole project life, but that is not it. So now, the relevant life less the break-even point, because if you are using 5, there is no uniformity. There won't be uniformity between these the payback period and the project life. And payback period exclude every other years after you've recouped the money. And that is one of the disadvantage of using payback period. That is one of the disadvantage of using payback period. I don't know if this is clear, please.
Yes, it's clear.
So you will help me solve. You help me solve. The next one is what? The next one. What is the next one?
Sir, please, I have a question.
All right. What is the question?
Sir, please, why did we use a discounted payback period to arrive at the break-even point?
Yes. Before I solve this, I have a question. That what is break-even point? So the break-even point of project life is at what point will you recover back the money you invested? If you invest 10,000 naira now, which year will you get back your 10,000? It means the point where your inflow and your outflow will be equal, that will lead to 0, is the break-even point of the project life. And for you to determine that, you need to use what? Your discounted payback period. Now, why are we using discounted payback period in this question? Because the question involves, we are giving a discount factor. We are giving a cost of capital. Take note, we have two types of payback period. We have the discounted payback period and just the payback period. So the discounted payback period is what you've seen in display here. This is discounted payback period, where you use your discounted factor to multiply your cash inflow. You understand? That is just the difference between the first one I showed while we started the class and this. So the discounted payback period will tell you that, okay, at this point, you've recouped back your money, 10,000 naira that you invested. So 10,000 minus 10,000 is what? Zero. So what is break even? Break even is the point where your inflow and outflow is equal to zero. Do you get that? And that is why we have to bring in the concept of what? Of discounted payback period. Is that fine?
Yes, I don't. Yes, but I don't really understand.
No, I want to know what you don't understand. Let me understand what you don't understand so that I will know what to say. If you don't tell me what you don't understand, I will
Okay.
not know what to say. So tell me what is that?
Um.
I'm waiting.
Okay. So you said that you said that the the year the
If
break-even
you
point.
don't
Now,
understand what
how
you
we are
want
going to get how okay, you said that how we are going to get our break-even point is the year that our cash flow equals the initial yeah, initial cash flow. That's what. But in this solution now, I'm checking the third year. The figure I'm seeing is not the same with the initial cash flow. So that's why I'm confused.
This is it, man. So please press your calculator. Add 8262 8282 400 plus 789 900. Are you there? Plus
Yes, sir.
7516 800. When you add those three, what will you have?
Okay, so that's all done.
Somebody should also help me add it. These three inflows.
828 900 5 3. Yeah, so you said two info 828 900 plus 7516 800.
Yes.
Which
What do
which
you
other
have?
one am I adding, sir?
You add
I have
one.
8.
When you add these three, 8 to
So I'll add
400.
what?
That
8.
is 23,690,100.
Good. Now help me add 1,309,900 to that. What will you have?
One. Sorry. So I said 1 million words.
No, just hold on. Let me get the answer I want first.
25 million.
25
25
million.
25 million.
25 million. 25 million. So you see all these inflows. All these inflows. Okay, let me attend to her very well now. So this is it. Umfong, on your
Yes, sir.
calculator, this is it. Press 8 to 82 400
Okay.
plus 7
400. Okay.
plus 7516
800.
plus 1309. This will give you what?
09 1309. So I said plus 1309.
Yes, 900.
900. I'm having 8476,100.
Don't worry. After the class, do it.
Go and buy
No, you have
correct
to even get
calculator.
it. You have to even get it. I don't know. It's just for you to add those simple maths. Or I should come and help you press it.
So you said I
Sir?
should add eight
We have
to
25 million.
8400.
Yes. Plus 789,500 plus 7516. These three. I'm not looking at my screen. I was pressing it too. I was typing it on the screen so that you'll see.
Maybe she's using her phone.
Okay. Yes, exactly. That's what I'm using. I'm using my phone to
Don't
add
use
up.
phone in my class. Don't use phone in my class.
Hello, sir. Hello, sir.
Yes.
That's one. I'm saying it's 30% or not 20% after the payback period. 4 minus 3.2 divided
Divide
by
by
400. It's 30%.
check it again, ma.
It's 20. It's 20%.
Okay, let me check it. Thank you.
Phone, don't use phone in my class. Go and buy calculator.
Okay, I'm sorry, sir. Okay, sir. And another question is, sir, please, why do we have 3 plus 1309900? Why do we have 3 there? 3 plus.
Why do we have 3 plus what?
Yes. This
This
3
place.
here is what I want to know. This 3 here, 3 plus. Why do we have that 3 there?
Now, when you have a discounted inflow of 7516800 in the third year, this is what you have in the third year as an inflow, and you are still indebted to the tune of what? 8,826,700. If you pay back 7516800 out of 8,826,700, what will you have left as owing? You have 1,309,900.
Okay.
1,309,900. So this 1,309,900, we are now asking in the fourth year, at what point are we going to recover it? We are now saying let this 1,309,900, we are going to divide it by what? The next cash inflow to now give us the period, the duration we are going to recoup back 1,309,900. That is what we've done here.
Okay. But how are you going to know that is at this point?
Hello, sir.
Well,
Hello, sir, Mr. Tobe. Hello, sir.
Yes, sir. Yes, sir.
She didn't join early. She can't get it now because you need to understand normal payback period. Even myself that know how to treat payback period very, very well. This discounted payback period is another wahala because you will not use the normal cash flow. You will use the discounted, that's the PV, to deduct it. So she will not, first of all, understand the normal payback period by asking that question: how did you get that trade before the normal division? You need to get the normal year now before that division, even the last line. How to divide it is another wahala. So she need to get the normal basic payback period before this.
Peter V.
Yes, thank you very much, sir. See, that is why I started my class from the basic. If you observe the flow of the class, I didn't just jump to the question. I started from the basic to what we've known, and we move in that order. Sometimes what I don't like cutting them short is that to look as if this thing, but thank God you are the one speaking as a student too. Yeah, so sometimes I just have to give listening ears. Yes, but if you have actually joined the class late, actually you will struggle with some of these things a little. Like if you've not followed the normal classes, Yes. But we, at this point, let me just answer your question. You said, how are we going to know that? Now, you
Yeah.
see, if you look at it, your next inflow is what? 716,100, right? Isn't it?
Yes, sir.
It
Yes,
is,
sir,
it
it
is more
is.
than what you have to pay back, isn't it? 1 million. So it means you won't exhaust all this value, isn't it? So in this,
Yes, sir.
your inflow, within what period will you recoup back this 1,306,000? So once you get that, what you do is just to say, this is your shortfall that is left, divide by your next inflow, which is what has played out here. See it, 1,309,900 divided by 7,160,100. You get two approximately here. So when you connect that with 3 to be 3 points, you have 0 point something. Yeah, 0.2 something. So when you add it to 3 to be 3 points, yes, and that is what has played out here. Next time you want to join my class, you join early. In case, but I've been seeing you, Sha. I've seen you in the class.
Okay.
So,
Okay. All right. Thank you, sir.
but in case it's not clear, just go back to watch the video again when I drop it, and it will be much more clear.
Or you can
Okay.
take a negative
Thanks,
point from the positive point. It will continue until it will give you the positive results.
sir, please, I'm
Sir?
so sorry. Sir, please, I'm sorry for bothering you. Sir, please, can you show the first solution so that I can screenshot it? How you determine the net cash flow so I can screenshot it. I was not.
So, sir, please, I have question.
Yes, what is your question? I need to round
No.
up my class.
Yes,
I need to go.
my question is that this IRR that you just did, the formula that you give, I think I don't know. There's one question that I come across it, but it's like a foundation aspect. The formula they give there now, they have A and B. Before you solve for A, you have to solve B before you get A. But this one, when I say it's like it's only A that you give. I mean, yes, I mean B that you give.
Sir, what will display there is the correct formula for IRR. I don't want to stress my head with that thing you've seen before. You understand? What you've
But
seen here
you
that
understand?
will display is what is IRR formula. Do you get, sir?
Okay.
Uh-huh.
Okay, but you understand what I'm saying, but because now you see summation brackets, them
No,
PV.
you see, as myself to even reason what you are saying.
No, sir,
Sir?
maybe he's following another textbook that they give him another formula.
So that is why I'm now summarizing it, that you should just go by the formula we've given in this class. I don't need that one that I have seen before. You understand? So
Okay.
in the formula can be put in any way. All you need to do just understand the application. Yes, you can write it anyway. If you check our normal classes, I didn't write it this way. I said lower rates, this, that. Do you understand? Just understand the application and you'll be fine. You get?
Okay. Okay.
So that is it.
Sir, can you forward this solution to platform for us if you can
Okay,
do?
I will forward it, sir.
Thank you, sir. God bless you, sir.
Guys, I even don't stress me.
Hey.
So this is it. This is the project live. Then we are to get the sensitivity in relation to what? Annual sales volume. 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 Now, when we talk about volume, the annual sales volume, If you watch that video of yesterday, what are we talking about? We talk about sales volume. What are we talking about? If you've actually watched that video. Anytime you hear volume, you didn't watch. Sensitivity to annual sales volume. Annual sales volume.
Mr. Tokwe, that's the sales price multiplied by the quantity.
Okay, sales price multiplied by the quantity. Okay. When we talk about sales volume, we're talking about contribution. I don't know. Do you have the slide for that video? For those of you in my, maybe I will send the slide. Yes, I will send it. Sensitivity to annual sales volume is contribution. Let's put it in bracket, please. Contribution. 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 So how do we get this, the sensitivity? How do we get our sensitivity? It will be what? The MPV of the project divided by what? PV of sales volume. MPV of the project divided by what? The PV of the sales volume. MPV of the project divided by PV of sales volume. MPV of the project. MPV of the project divided by the present value of sales volume. Of sales volume. All these multiplied by 100. Multiplied by 100. So MPV of the project so based on what we've solved before, we have our MPV of the project, right? The MPV of the project is what? Is this. Is this. So what do you need to do to complete this formula? What do you need to solve for?
The present value of the contribution.
Calculation of the PV of the contribution. The PV of the contribution. So now your PV of contribution will be what? Let's show it.
10,000.
Let's show it. PV of contribution. PV of contribution. PV of contribution. PV of contribution. That is your sales volume. Sales volume. And this will be what? The years. How many years are we looking at?
5 years.
So your contribution. Then you have what? Your discount factor. At what? At 5%. Then your PV. Now, we're looking at year 1 to 5. Year 1 to 5. Your contribution, based on your computation earlier on, is what?
10 million.
10 million. 10 million. So your discount factor based on annuity, using annuity, we are looking at year 1 to 5.
1.329.
4 points.
So
4
that's
point.
annuity. I don't know how to do it in my calculator. If someone can help me out, I would really appreciate.
Are you using a good scientific calculator?
Casio edition 2.
Yes, yeah.
Sir?
The model.
Yes, yes, edition 2. Casio edition 2.
Okay.
Second edition. I bought it with 15,000 for.
Jesus, I did not know how to add. And it's very hard to press. Chico and is easier to do it.
Sir?
Okay, all right, Mr. Shaibu.
Sir?
The annuity factor, I will just show you the formula. You follow the formula and you press it on your calculator. And there is no any special, there's no magic about it. You understand? So,
okay, sir.
Let's see, where is the formula even? I think I have it somewhere here. Annuity. So just write it in your book. This is it. Can you see my screen?
Okay. Yes, sir. This
1 minus, open bracket, 1 minus r to the power of minus n divided by r. So I want to conclude this class so that any story, some people are using data. Data is expensive now.
Sir, in my calculator, I'll place this n before raise power to n, or
Mr. Shaibu.
I'll place. Yes,
Mr.
sir.
Shaibu, reach out to me
Sir?
after this class. I'll show you what to do.
You need to rest also now.
I don't want the video to be unnecessarily crowded with
Okay.
yes. So
thank you, sir.
So we have our discount factor based on annuity will be what?
4.329.
4.329. So now PV, your PV will be what?
43,290,000.
43,290,000. Like this.
Yes, sir.
Okay, good. So now with this now, can you now determine your sensitivity to annual sales volume?
29.2%.
29.2%. So once you substitute into this formula, your MPV of the project as determined earlier on is what?
12,662,300.
12 million. I'm going to copy it. I don't have it somewhere. So 12 million. Then divide by this.
43,290,000.
Multiply by 100. So when you do this, you have what?
29.2%.
29.2%. So the question is, what is the interpretation? Even the first one, I didn't talk about the interpretation. What is the interpretation?
Can I
What
try,
is
sir?
it? Yes, sir.
Okay. It means that the sales volume or the contribution need to drop by 29.2% before we can arrive at zero MPV.
Okay. Yes. It means that these the for you to arrive at a zero MPV, the sales volume will drop by what? 29.2%. That is the lower limit. The lower limit will drop by that percentage. We drop by that percentage. So based on this understanding, please, everybody, help us solve. What is the MPV or the sensitivity to material cost Yes, solve for the sensitivity. Solve for the sensitivity. The formula is NPV of the project life divided by PV of material cost. PV of material cost. So you should be able to solve that. That's material cost per Zinco. The formula is NPV of the project life, which you already have in your solution. So the question is, what is the PV of material cost? Now the question is, how many units are you producing? How much is the material cost? Yes, material cost for 1 unit is what? 450. 450
So I
times
got
10
you 81%.
to
81%.
no, let's check it again, sir.
Okay.
So everybody solve, please. What will be the sensitivity to material cost? Sensitivity to material cost. Sensitivity to material cost. The formula will be equal to what? NPV of project life
I got 65%, sir.
65, ma. 65?
Yes, sir.
Okay, I think that is fine. So NPV of project life divided by PV of material cost. PV of material cost. So when you multiply this,
Sir, I'm getting 65%, sir.
you are correct, ma.
Okay.
So based on this sensitivity analysis, I want you, if you've not watched that video, I will check for the material I use in that video and forward to the group. Please understand it. Then simulation too. We've talked about simulation during our normal class. So it's very important to understand some of these things. And I will still take my time to go through my SFM documents to see some of the, but based on my experience on SFM, I know this cost of capital, investment appraisal, foreign risk management, these topics are what you cannot run away from. Yes. So, but the theoretical aspects, just read the theories. They can surprise us with Islamic banking. Yes, they can ask Islamic banking. So study that. And let's be open up to developing issues, even ethical issues. Yes, just open up your mind. Even as you read, have an open mind. That question can come from any angle based on the economic situation. So as they come, you apply your practical understanding and write as expected. So, because it's not everything that they'll bring out from your study pack. So they can ask some theoretical questions based on, they'll need your practical experience about it. Open-ended questions. So the calculation of your PV of material cost, how are you going to do that? So calculation of PV of material. I'm just showing this for those that have not arrived at this point. Calculation of PV of material cost. So we have the year. We have the cash flow. And we have the discount factor at 5%. Then you have what? Your PV. So the year 1 to 5, your cash flow will be 450 times what? 10,000. 450 times 10,000. You have it as what? Equal to 4,400,000. So your discount factor based on annuity, let's still use 4.329. And your PV will be what? Your PV will be what? For those that have solved.
19,480,500. 19,480,000.
Is it plus 500 or just 480?
Plus 500, sir.
So this is it. So you can now substitute this into this the formula, which is MPV of the project life is 12,662,300 divided by what? 19,480,500. You multiply that by 100, you have what?
65%.
65%.
Okay.
So this 65%, is it on a lower side or higher side?
Oh.
It needs to be increased.
Yes. It means what? The
It needs to be
interpretation of
increased.
yes, the interpretation of this is what?
It needs to be increased to the cost of material needs to be increased to 65% before we can have zero NPV.
Yes, material cost is 65% upper limit. 65% upper limit. 65% upper limit. So you can see going back to the question, that's what? Prepare a statement showing sensitivity 6 marks. These 8 marks, I'm so very interested in these 8 marks. Assess the strengths and weaknesses of sensitivity analysis as a method of evaluating risk and uncertainty in capital project appraisal. How does simulation provide an improvement over sensitivity analysis in this regard? So let's discuss what is the story about this. What can you reason out? Evaluation of sensitivity analysis. Based on your evaluation, what is the strength of sensitivity analysis? Based on what we've done now. Yes, can I get a response? Based on what we've done now, what do you think are the strengths of sensitivity analysis? The strengths. The person that is yawning, you can just put off your mind. So now, the strength of sensitivity analysis, what I've seen, to me, number one, is simple and easy to understand. Is it not simple? Is it not simple, please?
It's not simple at all.
No, it's very much simple. It's you that is seeing it as if it's not simple.
Like if you ask me to say number one, time waste.
Material cost cash flow. How we arrive at material cost cash flow? In the question mark, how much is the value of material? See it. The value of material is what? How much? To produce 1 unit, 450. Then you are producing 10,000 units. 450 times 10,000 units. That is how you get the value of material. Now, the sensitivity analysis, one of the strengths is that it is very simple and easy to understand. Another point you observe is that sensitivity analysis identify key risk variables. Key risk variables. And what are the variables we've identified in this question? We've looked at what? We've looked at product life, annual sales volume, and material cost per Zinco. So it identifies key risk variables. Key risk variables. And another strength of sensitivity analysis is that it helps management focus on critical factors, because once you identify these are the risk elements, then you'll be able to plan as appropriate as a management to see how to cushion, to ameliorate the risk that might befall your business in some time to come. So this is one, these are some of the strengths of sensitivity analysis, and it's used for decision making, just as I've mentioned. So once you see question like this, just think based on what you've done and write out, develop some points. I know at that point, the head might be too filled and heavy, but at least you can still do something. So write something. And if you look at the weakness, what do you think can be the weakness of these sensitivity analysis? What are the likely weakness? What are the likely weakness? Yeah, somebody should talk to me.
Difficult to calculate.
Why I say it's difficult to calculate. After I've said it's very simple to understand.
Yeah, I didn't.
Number one weakness I can see, it considers one variable at a time. Do you understand? When you are looking at sales, it's just sales only. When you are looking at material, it's only material, isn't it? It considers one variable at a time. So you look at what has happened, it considers one variable at a time. So by implication, it ignores interaction between variables. It ignores interaction between the price of a goods. It ignores the interaction between the contribution, because you are not putting them together. So it's look at each variable at a time. And one thing with this is that we are looking at the issue of uncertainty, but there is no probability attached. There is no probability attached. So you just reason out and see how you write. But the point is, you must understand, you must know what sensitivity analysis is for you to answer the question as appropriate. Yes, the fact that I'm saying just reason right, you must know what is sensitivity analysis before you can answer the question to the examiner's satisfaction. So the other part is they're asking us what is the power of simulation over sensitivity analysis. What is the power of simulation over sensitivity analysis? The question is, what is simulation? Can somebody respond to that? What is simulation? Simulation. What is simulation? No response.
Simulation looks at the impact of many variables at the same time, unlike sensitivity that consider a variables at a time.
Okay. So simulation, yes, it's you creating many scenarios to see how it will happen in the real life situation. Yes, when you have many possible outcomes of a project, Then you use probability distribution as a key variable to determine what will likely happen. What will likely happen. If you recall our simulation, Monte Carlo simulation, you discover that there's probability attached to it. So the strength of simulation, just as you said, now, it considers many variables at once, and it uses probability, and it shows range of outcome, either worst, best case scenarios, and the rest of it. So that is simulation. You can go through the Pathfinder. Let me even see what they put down there. Let's see what they put down there. Let me see. Okay, let me change my screen so that you see what they've put down there. Let's see what's has played out there. So you can see introduction, strength of sensitivity analysis. You can even see simplicity and clarity. Say it hard. Identification of critical variables, communication to decision making, decision support. You see weakness, one variable at a time is a limitation, no probability information, arbitrary input ranges, linear assumption, static approach. So how simulation improves on sensitivity analysis, probabilistic outcomes, interdependence of variables, holistic risk assessment, strategic insight. So you can see. Let me see how they ask the question, because I can see it in form of a report that assess the strengths and weakness of sensitivity analysis as a method of evaluating risk and uncertainty in capital project appraisal. How does simulation provide an improvement over sensitivity analysis in this regard? So you can see what they've asked us to do. So my advice is, let's go back to the one we treated in class and every other examples on this topic. Be fine. So class, we are on this time to meet as. Thank you very much. I'm going to send the recordings to us and the material.
Thank you, sir.
Thank you, sir. Oh, God.
Thank you, sir.